After discussing the different types of variable life insurance policy, now we will discuss the different types of variable funds that a client can invest in. In theory, funds is a collection or a portfolio of different investment instruments. Clients both bear risks and benefits of the variable life insurance policy in terms of life protection. The first fund that we're going to discuss is called cash funds. Cash fund is a portfolio or collection of cash and other forms of bank deposits. This is low risk and relatively safe. And we know that in investment law, low risk also means low return. Next is the equity fund. From the term itself, equity fund, this is a collection or portfolio of assets such as equity, stocks, shares, and etc. This is high risk in nature. Why? Because this is very volatile. It is uncertain if the investment will really yield high return. And the magnitude of change will always depend upon the quality of equities that the client held. And during market crash and recession, this is the first to immediately depreciate in high amount. However, high risk also implies high return. That's why investors who buy equity always aim for capital appreciation. Next is the bond fund. Bond fund is a collection of government and corporate bonds. As a review from our discussion during the Module 1, bonds is a certificate of ownership. You're lending money to either government or corporate institutions. This is relatively safe. Why? Because you are lending money from the government and lending money from corporate bonds. Corporate bonds are always given to blue chip companies or reputable institutions. It is also known as income or fixed income funds or fixed income securities. Why? Because it offers regular or fixed interest rates. Next is the property fund. Property fund is a collection of investment consisting of tangible assets such as real estate. This is definitely safer as compared to equity fund. However, this has very low liquidity. Why? Because this is invested in a non-liquid asset. It is not possible to quickly sell a property. When the policyholder redeems the unit. Typically, the insurer or the investor needs to find a buyer first to be able to liquidate this kind of investment. The fund manager may defer redemption typically up until 12 months. So if you need the money, it's not good to invest in property funds. Specialized fund, on the other hand, is a collection or portfolio of investment segmented based on geographical regions or particular industry. From the term itself, special. Now, fund managers can restrict the investment based on a particular region. Let's say investment are restricted to equities that are only in ASEAN countries, equities that are only in China, equities that are only in US. Fund manager can also make specialized fund specialized in certain industries such as technologies, mining, plantation, and public utilities. Specialized funds offers exposure to different markets in different regions of the world and different currency. However, it is very important to take note of the currency risk if it is invested in overseas market, particularly in times of volatile currency and financial market. Managed fund is a collection or a portfolio of equities, bonds, properties, cash, and etc. From the name itself, it implies that the fund allocation actually really depends on the fund manager's perspective. It is the fund manager who decides where the money will be placed or invested into. Normally, the fund manager provides higher proportion of equities and lower proportion of fixed income instruments when investing in managed funds. Balanced fund. Balanced fund is a collection of high-risk investment instruments and low-risk investment instruments. From the term itself, balance, the fund manager typically balances out equities and cash instruments and bonds. So to wrap up all of these funds, it is important to remember that when you are investing in different investment instruments, high risk always equates to high return. Low risk equates to low return. Now we can take a look at the risk versus return chart. On the x-axis, we can see the potential return. On the y-axis, we can see the potential risk. We can graph the funds that I discussed accordingly to the potential return and potential risk. If you would notice, cash fund is at the lower portion of the chart. Why? Because this is the fund that has the lower risk and also offers the lowest return. And then bond fund follows. In the middle, you would see balanced and managed fund because it offers moderate risk and moderate return. Properties and equities are at the topmost portion of the chart because these are the most volatile and the highest of risk of all investments. However, it also offers the highest returns.